So when the market is down in retirement, what you want to do is if you have a different asset that you could tap into, whether it's a home equity loan, whether it's high cash value life insurance, whether it's just a savings account. Now, not all assets are created equal, and not all of them are as efficient. But if you could tap into that and let the market recover, you would be much better off. This is BetterWealth with Caleb Guilliams. Hey everyone, welcome back to another episode of the BetterWealth podcast. My analytical friends will love this episode because I'm going to be getting into the nuts and bolts of volatility buffer, sequence risk loss, 4% rule, and show you an example of the power of having a volatility buffer strategy. Now, if this is the first time you're hearing of the volatility buffer or sequence risk loss or 4% rule, thank you so much for being here on either my YouTube channel or listening on my podcast. You want to go back and check out some of the later episodes. You can check out the episode I did with Dr. Wade Fowle. You can check out the episode that I did with Jason Sanger. I've also had other episodes where I talk about the 4% rule. And there's just a lot of problems in retirement. In quick summary, there's a lot of problems when it comes to retirement planning, and a lot of people are not thinking with the end in mind. And one of the I would say principles that I talk about in my book is every time you lose a dollar, you don't just lose that dollar, but you lose what that dollar could have earned the rest of your life. And when people are investing for the future, if the market drops, you will have a way to buy at a discount. And it's called dollar cost averaging. It actually can be in your favor over a period of time. But that thing that helps you going up the mountain works exact opposite going down the mountain. And I think a common theme that you're going to see in this calculator is every time you lose a dollar, you don't just lose that dollar, but you lose what that dollar could have earned you or produced for you. And it's really an exponential negative thing in retirement. And so with that, we're going to go into truth concepts, and I'm going to break down a scenario that I think will do a good job illustrating the 4% rule, the sequence of risk loss, but more importantly, how you can use a volatility buffer today, whether you have stock market assets or other assets, and it can really help you create more certainty in retirement. Hey everyone, welcome back to another episode of the BetterWealth podcast. I am in the studio, and as you can see, I'm on my computer. If you're watching this on YouTube, this is going to be a very friendly video for our analytical friends, and I'm going to go into the volatility buffer strategy and why it could be very beneficial for you as it relates to, if you're using a lot of stocks or, retirement plans for retirement, the volatility buffer could be something that could give you potentially double the cash flow if you do it properly. And the volatility buffer strategy, I could summarize it by essentially saying when the market is down in retirement, the last thing that you want to do is pull from assets, because not only are you selling at a loss, but you're doing that at an exponential rate. So when the market is down in retirement, what you want to do is if you have a different asset that you could tap into, whether it's a home equity loan, whether it's high cash value life insurance, whether it's just a savings account. Now, not all assets are created equal, and not all of them are as efficient. But if you could tap into that and let the market recover, you would be much better off. And if you're just starting saving, like there's a ratio. If you're nearing retirement, there's a ratio, and you should work with someone that understands these kind of strategies, because the 4% rule in some cases is a little aggressive, meaning you could run out of money. And then if you have certain strategies, they could be very, very good. So what I'm going to do, and I know anything that I do, I get feedback on, good and bad. So I'm just going to use Truth Concepts Calculator, and I want to illustrate over the last 20 years a simple what a volatility buffer could do for somebody, and the damaging effect of if you don't have a strategy set up, what that could entail. Now, a lot of people are talking about a 30-year time frame. I'm going to look at 20 years just for illustration purposes. But again, you're going to see some things in 20 years. Just imagine doubling that time, because some people potentially will be in retirement for the next 40 years. Now, not everybody, but just something to think about is what I'm showing you is just a short snapshot on time. I could cherry pick dates that are better and worse, but I'm just kind of giving this example. The other thing that I just want to say is we're going to look at history, and looking back at history and to try to reflect on future opportunities could be also a negative thing to do as well. So what I'm going to do is I'm going to we're going to go for the next 20 years. And I'm going to put a present value of $1 million. Why $1 million? Because $1 million is just an easy round number to use, but this would work if you had 100,000. This would work if you had 3 million. All right. And what I'm going to do is we're going to look at the market, and we are going to go to the S&P 500 with dividends for the last 20 years. And this is an average of 7.63%. Okay. So if we take 7.63% and we just assume the average for the moment, and we say 7.63%, you'll see that over 20 years, your nest egg from $1 million grows to 4.3. Power of compound growth. And what we're going to do is we're going to be conservative, and we're going to say we're only going to take out, let's say, $50,000, and we are going to increase 3% because all these calculations have some kind of inflation adjusted spending. There's some people that say you're not going to increase your spending by 3%. There's others that say, hey, when every day is a weekend, you'll be spending more. I'm just using this for illustration purposes only, obviously. So in this example, you are, over the next 20 years, you have $1 million. You're earning a rate of 7.63%. You're taking out $50,000 increase for inflation. So the first year is 50. The last year, you're taking out a little over $87,000 of income, and you can see that your ending balance is 1.3 million, almost $1.4 million. That obviously, like, math is a beautiful thing. That's an amazing thing. And so you could look at this and you could say, if the market is averaging over 7%, you could be conservative and take out, let's be conservative and take out $60,000. Let's be conservative and take out $70,000. I mean, logic would say that you could even take out $70,000 with inflation, and after 20 years, you would have money. Now, a 20-year time period also is kind of risky, and this is just for example purposes only. Now, what's interesting though is, remember, whether it's my book, whether it's experts, everyone's saying losses affect are a really bad thing in retirement. Like, when you lose money, it's a really negative thing. And so we're going to do is we're going to go back to the same time period that averaged 7.63%. I'm going to just copy this last 20 years, copy, and then I'm going to go back over to the tool and go back over to the cash flow tool, and I'm just going to paste the actual rates of return. Okay. And we ran out of money, ladies and gentlemen, in year 11. Why? It's because this averages don't mean a whole lot when it comes to taking out your money. Now, in all fairness, let's bring this back down to 50,000, negative 50,000. So if we just took out 50,000, we still lose money. We're taking out 50. We're taking out 5%. We're not even looking at 30 years. We're taking 5% adjusted for inflation, and year 16, we run out of money. Okay. This is the big problem as it relates to retirement risk. Now, even Dr. Wade Pfau, when he says, look at interest rates and look at where our market's at, we may not have some of these runs. You look at 28%, 15%, 25%, 32%, 31%. Like, there's a lot of good runs here. We might not even have some of those runs in the future. It's like, this is where the risk of retirement is. But the cool thing about the volatility buffer is the volatility buffer says, assuming this analogy here, what if we did not take out money the first couple of years? So what I'm going to do is I'm just going to put 0 here. And then I'm going to put in, 50, we'll put in 52,000. We're adjusting for inflation. I'm going to put the negative number here. And let's say we take out that. Okay, we can see just by eliminating 3 years early on, just eliminating 3 years, you didn't just run out of money. Now you have some kind of balance at the end of 20 years. Well, in this loss here, I'm going to put 0. I'm going to put 62,000 over here. And, well, here, I gotta put a different number. So if I just use 4 years of volatility, I could even do this here as well. But if I just take 4 years of volatility over 20 years, 4 years, you are going to, instead of running out of money in year 11, you are able to sustain and have over $348,000 of income. Now, 5% is, again, could be pretty aggressive. You still might need to take out a little bit less, but we're also, in all fairness, we're showing three years of losses, and there's not a lot of periods of time that you lose 3 years early on. And so again, I want to point out that without the volatility buffer, you ran out of money in 10 years. After 10 years, you're out of money. How is that possible? It's because taking out money is bad enough. With taking out money at a loss is even worse. So volatility buffer is essentially saying, if you have an asset, whether it's a home equity, line of credit, whether it's a whole life insurance policy, which I'm a huge advocate of if set up and used properly, even if it's a savings account, or if it's being creative, tapping into other sources of income, your kids or whatever, and you get to let the market rebound, it's still not great, but it can be a difference of an extra 10 years and 348,000. Like that's a pretty big difference. Now, again, I hope this just did a good job just showing you the power of again, having an asset that eliminates the downside losses. And we could go back in history, we could take over 30 years, and you could see really quickly that retirement is really tough. And while the stock market for some, and I'll say for many, are the asset of choice for accumulating money for the future, I would highly recommend you talk to someone or work with someone that can help you as it relates to addressing distribution and retirement income. Because I'm telling you, the market, while it might be a good asset to increase your money, it might be a very poor asset, as you can see, to distribute your money. But if you're going to do that, just by adding a 4, 5, 6 year volatility buffer, it can do some incredible things. The last thing I'll say, and this is my little reason for the reason I'm doing this, is because I'm making a movie on the AND asset, over essentially teaching people how to overfund whole life insurance and showing them how that can be an asset that can improve every part of your life. And a lot of people talk about it as a part to do infinite banking. And I think very few people should actually practice infinite banking, just because I don't think a lot of people have the mindset, and they'll end up messing it up. But I think a lot of people will use their money and put it in the market, and all they really want is a powerful retirement. So if you could work with somebody that could help you set up from day one an ability to have a volatility buffer or have options for the future, you could potentially double your retirement cash flow. Double your retirement cash flow. Imagine the actual value of that. People are spending their whole life and not spending a single hour talking about income-based strategies as it relates to retirement that will give you more income, certainty, and options for the future. So again, hopefully you enjoyed this little video, this of numbers, and just showing you a real-time example of why a volatility buffer could be a game changer for you in retirement. Thank you so much for listening to the BetterWealth podcast. It would mean the world to me if you could hit subscribe, leave a review, and share this with the people that you know and love.